I mean, I would say that obviously with the interest rate cap, which was a major regulation coming through in 2016, 2017 was slightly difficult. But I would say that today we don't have an environment where banks can say that it's certain. The element of certainty, predictability, that is, we don't see in business anymore. I mean, the last decade, I call it a very volatile, uncertain, complex, and agile environment. You really cannot say, before we could see 5 years ahead, today even seeing 2, 3 years ahead is absolutely different. I see few companies that can project globally even, 3 years from now. Amount of disruptions, fintech into our own space, new regulations, a young generation, dynamics are changing. So we have to be on our toes. And because today is the world of the customer, so the customer is always aware. I call it, everyone seems to want personalized service. We have to continue to create machine learnings. Or that's what we see even in our own bank happening. But for us, last year was, I would say, a stable year. We didn't grow as much. Our loans were up 10%, so we crossed half a trillion shillings in terms of lendings. We had a very good lending on our mobile platform, KCB M-Pesa. We crossed over $300 million in the year. We have 10 million customers now. I mean, so we're very, very close in terms of the largest lender, which is M-Shwari. The two of us are leading in that aspect of lending to micro enterprises. And then lastly, the only thing that, and on interest rates, we didn't lose. We lost a lot of income on the margins. The margins came down over 60 basis points, but they were more than compensated by the increase in the volume. So we grew our loan book by 10%, whereas industry was growing at 4-5%. So, and there is opportunity. So we extended more loans into the consumer space. We extended to some sectors in the economy where we didn't have problems in the large corporates. But our mortgage lending, our SME lending, and micro enterprises showed negative growth on a year-on-year basis. So I would say, yes, we had this performance where we were flat on a year-on-year basis. But if you capture in that we had a huge restructuring last year where we released 300 staff, if you compare like to like, we are going to grow our income, our net income, by 14% on a year-on-year basis. Mobile lending, yes. So it's a small business. The volume isn't as much. So we're saying, $300 million in a year. But largely we say that we are in a $5 billion. So it's a small element. It's less than 5%. You'll be very surprised that the demand for credit is still there. The question is whether can we price that risk to the customer who is coming before our doors. And we have to reimagine a new frontier for financial institutions. So if we stick the same old business model, in fact, I like what the governor of the central bank speaks about. Banks must rethink their business model. Because traditionally, we have been used to pricing every single risk when you have opportunity. With interest rate cap, we haven't been able to. So as a leading catalytic bank on the consumer lending, what the lower rates of 14% meant is more salaried people or businesses could access credit. And that's what banks have been doing. So for us, because we're a big lender in that segment, actually 1/3 of our lending into the consumer segment. And that, even today, there's a lot of credit. But mortgage lending, we couldn't be able to lend. So if your portfolio or your concentration risk was different as an industry, then you were not lending. The sectors that we saw less growth was on SMEs and micro enterprises. That we didn't see growth at all. In fact, we saw our loan book declining. And that is a general trend in the industry. So I would say that we've been able to, so we push forward for us to remove of the interest rate cap. I personally don't believe that one rate addresses the challenges we're facing in the industry. So we're going to find a better way. So first we advocate for removal of the entire interest rate cap. So a complete repeal, unconditional repeal is what we're asking for the current interest rate regime. But it doesn't mean that banks need to go back into the old model. And we need to be able to find mechanisms, whether it's consumer protection guidelines for customers' financial sector, so that customers don't feel exploited. So there has to be an element of responsible lending by banks, although we have never demonstrated it in the last 50 years. But this is not necessarily a scientific process. Parliament knows that interest rate caps are not good for the economy. We have a very experienced economists, public sector experts in Parliament. You know them. People who have spent many times in financial sector, policy analysts, research institutions, they're there. You've got experienced financial experts and accountants in Parliament. I think the question which we have, which we need to deal ourselves as industry, is what do we offer? The governor of central bank calls it a down payment. Yeah. But let's be clear that what we are looking for is a free market operating model for financial sector. That's what we are looking for. Yes. And for us, what we can do is perhaps on some sectors where we see, do we want an acceleration? Do you want to have a specific action to drive growth in those sectors? So if you're thinking about SMEs, you're thinking about the housing programs under the Big Four agenda, 1 million houses, 500,000 houses in the next 4 years, then maybe we can be more specific. So the industry is thinking on providing what you call an Inuka fund, a more targeted program targeting 1 to 5% of total portfolio. But that has not been proposed. And in my own view, without any kind of proposal from industry, I don't think Parliament is going to give us the repeal of the law. So you're right on that question. So who moves fast? Yeah. Without a change from the industry, Parliament may not be able to repeal the law. So I would not say that there is no certainty today that the law will be repealed without banks providing a mechanism. And that's where we sit today. So we are working behind the conversation. And KCB, we always insist on, yes, we need the interest rate law repealed from Parliament, but we need to throw in a mechanism to ensure that we are preparing to support enterprises with a new regime. We don't go back to the 20-25% pricing we saw before. So the jury is out there. I do not think that there is any CEO of the industry who can say that there is confirmation today. That can only come from Parliament. And listening to the Speaker, listening to the Leader Majority, listening to the members of Parliament, listening to the committee itself on finance, they say this is going nowhere. And I think the parliamentarians are right at this stage. So we will continue pushing. What is our strength? We are saying we need a free market. Global players like the IMF, the World Bank have said this is the way to go. But there has to be a political conversations happening between Parliament and the National Treasury, and banks must give alternatives. And we will be prepared to provide alternatives as industry as long as they allow us to operate in an open market. So that is the kind of right that we support the changes at the industry level. The expected loss model, which is the new approach that IFRS9 is asking us to consider lending portfolios. So the probability of default for a particular customer is something that, so we need a lot of information and data. So economic analysis, thinking about which economy, how each sector is doing. The biggest impact for banks is that first, it's a very complex model. So like for us who have got 10 million customers who are borrowing, for each of these customers or groups, we should be able to have a model that predicts how they will perform once we lend the facility. So we've been building this data from 2010. So in our credit scoring model, we did put probability of defaults for each of these customers. So we were building in an expected loss, although we were not using it in provisioning. So we found it that we already had enough data to be able to use it in our provisioning model and IFRS9. So we will be able to comply ourselves from beginning of January. In fact, we've started the compliance. But the greatest impact is because we have not been providing enough capital for the losses that we expect from those names, then it's a real capital adequacy question. And so this is why I presume the central bank has provided some window. I mean, they didn't say that, they say that you've got the guidance of 5 years, but I believe that in reality, banks like KCB, we will not have more the year. This is the year to comply and meet our capital requirements. So if you think about the impact for us, our capital adequacy ratio will drop by 100 to 150 basis points. And because we have an internal buffer of 250 basis points, we are well within our own expectations. But the capital question is going to be the greatest impact for financial services, for banks with IFRS 9. It's not even a P&L question. Do we have enough capital? Because on day 1, January 1, 2018, you need to make a provision for all those loans where you think they will not perform. So for us, we had set aside a capital of 10 billion under a statutory loan loss reserves in our balance sheet, under capital before. And so if you didn't say that before, so our capital will actually drop by 10 billion beginning of January, which is what has happened. But because we were ahead by 20, we are still within the capital adequacy requirements. We are complying from 1st of January. For us as a large bank, we've done our models. We had working with our external auditors. We had an external consultant who was a specialist in IFRS 9. We spent the entire 2017 adopting. Now, so the only issue we have is the capital adequacy question. And I think that's perhaps the reason where if we feel that we are nervous as an industry, we will need more time. But for KCB, we are adopting because we see that we have adequate capital required to meet the provision required in IFRS 9. It's an exciting issue, to be honest. But also, it means we must be very pragmatic and very deliberate on who we lend to because of the risk that they pose to the sort of capital structure. So banks must be better off now in managing their capital. China is an amazing engagement for us because with the One Road, One Belt project that is being launched, and Kenya is the only link on the eastern coast of Africa, on the Indian Ocean, on this project. So the railway is one of the greatest links on this. Okay, so we will see that a lot of the Chinese, our customers from China, are looking for a bank that is Kenyan bank that has got a footprint and a space in China to enhance trade, to build businesses, to enhance transactions, and make the settlements happen. So we've been involved from the SGR from day one, as a bank of the China Exim Bank. Now, what we see is that Beijing will make us grow our Chinese businesses or importers or exporters or manufacturers in our market within the region that no other bank can do. So we see one bank in South Africa, which is the Standard Bank, but we see ourselves in Eastern Africa as the go-to bank for Chinese investors coming to East Africa. And that's why by this September, we are opening up our office in China. We are not able to set up a branch at the moment, but naturally, the way you build a bank within a new entity in a new country is you have a rep office, and then depending on your capital requirements and your experience in that country, you migrate it into a branch. So today, IFRS9 brings in more problems for financial sector, for sure. And I would say that we don't have a good framework today to deal with the issues of provisions which are being disallowed by the revenue authorities, although the central bank requires us to make those provisions, and the IFRS9 is a big demand for us to do it. So, I mean, this kind of three different dimensions need to be aligned collectively, knowing that KRA has got specific regulations to follow, has got its own rules and the law anyway to apply. But I would say that the National Treasury, so the Minister of Finance should be able to lead a conversation that gets convergence. Because we all want to build enterprises that collect more revenues, correct? But also being able to comply with the guidelines that are available for different aspects for banks. So this is going to be a very difficult year for financial sector because as we bring in a new standard, a lot of those provisions are not being allowed. And yet, that is the dispensation. And Kenya isn't different from other dispensations. We can look at what's happening in Europe, look at what's happening within OECD countries, and see whether we can be able to replicate or apply.
Because they want to deal with these emissions.
Absolutely. But the idea that we are building, we don't have to reinvent a new box, correct? Or a new model in our markets. When most of this, IFRS9 is a global benchmark. It's not even a Kenya-centric kind of regulation. So that's one area that what the industry is doing is I like to see perhaps more coordination between these three entities, the regulator, the tax authority, Ministry of Finance, and the industry, in terms of working out the guidelines that will make it both profitable for us to be able to operate and remain compliant with the regulations in terms of tax compliance.